Have you ever been told that you need to carry a credit card balance in order to build credit? Or have you avoided credit cards completely due to being terrified of debt? Well, today we're going to tackle the most common fears and misconceptions on your path to understanding your credit score. Welcome, new and returning Money Buddies. I'm your host, Skylar Fleming, and there are a whole lot of myths out there that I have heard about credit and credit scores, and we're going to debunk a lot of those today. You're going to leave this episode feeling confident and knowing how to actually build your credit score to the best that you want it to be. Today, you're going to actually learn what goes into a credit score, and like I said, I'm going to debunk some of those biggest myths that keep you from building credit. And you'll be able to walk away with a simple plan to build an excellent credit score without having to carry debt. So I know you're going to get a whole lot of value out of this one, so make sure you stay tuned through the entire episode because part of the CFP curriculum is memorizing and learning all about the credit score. So I'm excited to take what I learned there and give it all to you today. There are a lot of myths I'm going to debunk, and you're going to be able to understand what a good credit score actually is and why it's a whole lot easier to obtain than you think. The best part is that you can have a great credit score without having to carry credit card debt or really any sort of debt. If you don't want to, you can still have a great credit score that gets you that good insurance rate or gets you into the apartment you want. There are a lot of great things that you're going to be able to walk away from today's episode with. So let's get into today's episode and really start teaching all about the credit score. The main problem that we're going to tackle today is that so many of us aren't really sure what actually goes into a credit score. Do you have to carry a credit card balance? That's something that's always floated out there. Do you need to take out a loan and pay interest in order to get a credit score? Well, the answer to both of those questions is no. You don't have to carry a credit card balance or take out a loan, but we're going to get into a lot more detail today and talk about what actually goes into your credit score so that you can really understand it. Because like so many of us, our parents told us to spend less than you make, but we were never really taught how a credit score actually works. And now we're supposed to figure it out on our own while being bombarded with contradictory and confusing TikTok and Instagram videos. So it's definitely a bit of a foggy area that no one really teaches us about. So I'm excited to share with you today what I've learned about credit scores. So let's get into it first with an article here from Fidelity. It's linked in the show notes, but it's titled 7 Ways to Build Credit at 18. The first way that I want to share here about getting started with building your credit is potentially getting yourself added on as an authorized user onto someone else's card. It's a fantastic way to get started, but you have to make sure that the person that you're getting added to their card, they have to be responsible with their own credit, because if they suck with the credit cards, it's just going to drag down and impact your credit score as well. So in the same vein that getting added to their card can be a great way to boost your credit score, if they're bad with their credit card, it can be a great way to hurt it. But a good option is if your parents are good with credit cards and they've never had any credit card debt, it might be a great place to start to ask if you can be added to their credit card as an authorized user. You might also ask a friend if they're really good with credit cards, if they could add you as an authorized user. But you may not want to go that route. It might be a little too risky because what if your friend decides to suddenly damage their credit or whatever, right? It might be a little too risky. And the other thing that might be useful here is if you're being added as an authorized user, mention that you don't need the actual card. Just ask if you can get added on to your parents' card as an authorized user, or maybe a sibling that's really good with credit cards, and then you can benefit from their good credit history. You don't need the actual card. You don't need to spend on it. Their credit history can be handed over to you because you're an authorized user. But make sure you're careful. You absolutely have to make sure if you're doing this strategy that the person is responsible with their credit card debt. The next thing that Fidelity recommends is to open a secured credit card. This is another great way to build credit. So here's how it works. You offer up a few $100s or maybe $1,000 as your secured line of credit, hence the name secured credit card. So your $1,000, just for this example, is going to become your limit on your credit card. So that $1,000, that's how much you're going to have available to spend. That way, if you're ever unable to pay your credit card, your secured deposit that you already gave up front is going to be able to be used to pay off that card. So it's a great way to get used to using a credit card without having to worry about getting in debt. And you're never going to be able to get to the point where you're unable to get out of the credit card debt because you know you have that secured deposit holding up the credit card, ready to jump into action if you fall behind on your credit card. It's a great way to get started, and it does help you build credit. A couple more things here from the Fidelity article include making payments on time. To me, making payments on time and paying off the full statement balance is absolutely essential. If you don't pay off the full statement balance, then you're carrying credit card debt. And a credit card can be one of the most dangerous things to your financial situation. But let me explain real quick here what the statement balance is to make sure this makes sense to each of you. Every single month as you use the credit card, your credit card company or whoever will issue you a statement that contains all of your transactions for the last month since the last statement. The total balance owed on that statement is your statement balance, hence the name. And if that amount is paid off by the due date, you do not owe any interest on that amount. You only get charged interest on the amount that rolls over from month to month. And paying off that statement balance is how you can use a credit card without ever having to carry credit card debt. And you can improve your credit score. By doing this method, you don't have to carry credit card debt and pay interest. The next tip from Fidelity is to keep your credit card balances low. If you keep them low, it's a great way to maintain a high credit score. And even if you're paying them off every single month, if your statement balance is still high relative to your credit limit, it might not look good on a credit report. So let's say you have a limit of $10,000 and your monthly spend is $8,000. That's an 80% usage rate. And even if you pay it off every single month and avoid interest, it may still not look good for your credit score because you have an 80% utilization rate. That's why it may be important to have multiple lines of credit open or have a larger available limit. That way your percentage of your usage of your credit limit isn't as high. So whether you put all your expenses on one card or multiple, your credit score looks at all of your available lines of credit. So make sure you're keeping that number lower. The last tip here from this Fidelity article is to start early. This is where getting added as an authorized user or opening a secured card early can be so helpful. It can be such a great way to start building your credit score. And if you're a young adult who has kids and you're really good with your credit, you could consider adding them as an authorized user to your credit card in order to build them a very long and very good credit score. But also, don't damage your kid's credit score. If you're not sure how to handle debt yet, and maybe your credit score isn't in that perfect area where you want it to be, don't damage your kid's credit score while they're little. That's super lame and not cool, and there can be problems down the road if you do that. So make sure you're careful and make sure you know how to handle your own credit before you start trying to improve your kid's credit score. So be careful in that area. But that does it for this first Fidelity article. The next one that I want to get into is going to talk about what actually goes into your credit score, how it works, and why it matters from NerdWallet. So there's a couple key ranges to know as we get started talking about the FICO score and your credit score. If your credit score is above 740, you're probably going to get some of the best rates available. If your credit score is above 800, you may even have some negotiating power when it comes to taking out debt. But guess what? You really don't need to push too hard for that super high, perfect 850 credit score. Don't stress yourself out. Just get into those top two tiers and you're going to be okay. It's really not worth it, and it takes a lot of effort to get to that perfect 850 credit score. And I've even heard some credit score models go higher than that. So I'm sure they'll just push the number out to make us keep chasing and continue trying to chase a perfect credit score because it's not really necessary. But what actually goes into your credit score? So this is the meat and potatoes of that magical number. Well, 35% of your score is your payment history. 30% of your score is that credit utilization. 15% of your score is the length of your credit history. 10% is how much new credit you have, and 10% is your credit mix. The payment history piece of all that is pretty self-explanatory. It's just making sure things are paid on time. But 30% of it is credit utilization. That's what I talked about earlier with making sure you're not taking a higher percentage of your available credit and using it all. It's a very weird and silly balance, but if you get it right, it can really help your credit score. The length of credit history has to do with how long your accounts are opened. This is why you'll hear people say, don't close that very first credit card or it's going to hurt your credit score. But length of credit is an important piece as well. But your new credit and your credit mix, that has to do with opening new accounts and whether all the accounts are the same type or whether you have different lines of credit, mortgages, auto loans, student loans. I think you get the point there. Those ones are pretty easy as well. And now that you know how to start setting yourself up on the right track, I want to bust the top 3 myths that I most commonly see. So the first one here is that credit reports and credit scores are not the same. This one is true. They are different. Your credit report contains all of your credit information and a ton of personal information about you. Your credit score is just a number that has to do with all those factors that we just talked about. Your credit report is something that you want to check regularly for fraud, because another fact is that checking your credit report is free and it's a way to prevent fraud. Check out annualcreditreport.com, or you can create an account with the separate credit bureaus. But guess what? Do not pay them a dime. This really just gets me going. I'm so frustrated with this. But when you create an account, they're always going to get you to sign up for some dumb subscription for your credit report. You don't have to do that. I check my credit report regularly and I've never paid a single dime to any of the credit bureaus. I just set a quarterly reminder on my phone, log into the different platforms, and I quickly peruse them to make sure there's no fraudulent information in there. I've had fraudulent information on my credit report before. It was very easy to remove, thankfully, but it's important to check because this information on your credit report, that's where the questions to verify you when you try to log into a government account or whatever, that public information comes from your credit report. So making sure it's accurate is important, especially because it could be a great way to catch fraudulent lines of credit that may be getting opened up in your name. It's a great way to catch identity theft on your own. The next myth that I want to talk about is that your credit score doesn't matter. It absolutely matters unless you're dedicated to a cash-only lifestyle. And even then, your credit score probably still matters a bit. It's going to make things a little bit trickier if you decide to completely avoid your credit score. And yes, it does stink because everything now uses our credit score as a way to determine financial stability, which may not be the most accurate measurement. From jobs to insurance to landlords, they may all look at your credit report or some form of your credit score to be able to determine your financial stability. And that does stink, but it is something we just have to consider and part of the game that we have to play. But it doesn't have to be so complicated. You don't have to pay an interest charge in order to get your best credit score ever. And we're going to talk about that in today's real world application. I have a case study coming up next where we're going to dive into how you could improve your credit score. And we're going to look at a situation featuring Priya next. So to introduce our situation here, Priya is a 27-year-old research coordinator in Philadelphia, Pennsylvania. She earns about $72,000 a year. She graduated 5 years ago with a bachelor's degree and has been making consistent payments on her student loans ever since. While her student loans have always been automatic and on time, she's never bothered to check her credit score or her credit report. Priya has been using a debit card for everything since college because she has heard horror stories from friends about getting buried in credit card debt. So she has avoided that stuff like the plague. She's avoided a credit card altogether because in her mind, if she doesn't have one, she can't overspend. Recently, Priya's 2014 Honda has been having some issues. So she's starting to think about purchasing a more reliable car in the next few years. She's thinking it may need an auto loan. She's been dating someone seriously for the last few years. They're starting to talk about their future together. This is all leading to some questions about buying a home. How do they bring their finances together? How does their credit scores impact their options? And during a conversation with a coworker recently about car shopping, Priya's coworker mentioned that she's getting a fantastic interest rate on her auto loan because of her credit score. That made Priya realize that she has no idea what her credit score even is. So when she finally checked it out of curiosity, she discovered her score was 700. Not terrible, but not as strong as it could be, especially given her perfect student loan history. She wasn't sure how she could improve it, but she knew that if she wanted to finance a car, she needed to strengthen her credit score, and that it was going to be an important piece if she was going to apply for a mortgage in the next 5 to 7 years after a potential marriage. But she's nervous about credit cards. She's not sure how to get this started because she doesn't want to fall into the trap of carrying balances and paying interest. So that's the introduction to Priya's situation. So let's walk through a little bit here about how she can begin to build her credit score. And I hope this works for each of you listening to be able to say, yeah, I can improve my credit score as well. So let's walk through it. Priya did the absolute right first thing and actually checked her credit score. If you're in this situation and you're unsure what yours is, go to annualcreditreport.com and start there with getting your credit reports and trying to get your credit score. It's also likely that your bank or credit union offers a free credit score and may even give you a free credit report. But to really start building a credit history, you're probably going to want to look at that secured credit card that we talked about earlier in the episode. And I know Priya and probably those of you listening may be nervous about a credit card, but a secured credit card is a great way to calm those fears. It's a great way to get started because you don't have to worry about getting into a ton of credit card debt because they have a smaller limit and it's secured. They're a great way to start building habits. And speaking of habits, the habit I would recommend is take that secured credit card and start putting a small recurring expense on it and get used to paying that off every single month in full. Set a regular reminder on your phone to help you get into the habit of this. That will take some of the stress off of your mind. I'd recommend paying it off on the first of every single month. Of course, you always want to check the balance and make sure it's paid off every single month. And if you're doing it manually at the beginning, it's a great way to just know and get that peace of mind that your credit card is paid off. And then you can move to an automatic payment to pay off the statement balance. Every single credit card company out there has a way to set up an automatic payment to pay off that statement balance amount so you never have to pay interest. So now that I've moved to this point and I don't have to do it manually, I let our credit cards pay off automatically on the due date with that automatic statement balance payment. It's a great place to get to because the stress is off my mind now. I know the credit cards are always going to be paid because that automatic payment always works. Really, in this situation with Priya, credit cards are going to be the best way to start building credit, and you don't have to get into credit card debt to do so. This could be combined with getting yourself added as an authorized user on a parent's card if they have good credit habits, because having your own and having one as an authorized user can be a great way to build your credit score even faster. But the real habit to take away from this is get used to paying it off in full every single month. Once you're used to that, it'll be smooth sailing with other credit cards and other forms of debt. So the results of all this is that Priya's credit score is going to begin improving very quickly. The credit agencies are going to start to see that regular and consistent repayment history, and Priya's credit score and yours is going to shoot up very quickly. Within 6 months of using our secured credit card responsibly and starting to get a new credit line developed and that regular and consistent repayment history, Priya could see her score jump as much as 40 points. And by the time she's ready to buy that car in 2 to 3 years, it very easily could be way up in that exceptional range, qualifying her for the best interest rates and saving her thousands of dollars. And this is the exact experience that happened for my wife and I. We have a lot of different credit cards because we like the credit card travel hacking game. But once we got started with credit cards, our credit scores shot up very quickly. And that allowed us to get a very good interest rate on an auto loan that we had to get a few years ago. It allowed us to refinance Rebecca's student loans at a very great interest rate. So playing this game just a little and improving your credit score up into that very good and exceptional range can save you a lot of money on an auto loan or your student loans. That's the main takeaway here. A good credit score can have a lot of impact on your personal finances. And guess what? One of the main objections I always hear is that you have to carry a credit card balance in order to boost your credit score. That is not true. You do not have to be in debt to the point that you're paying interest in order to have a good credit score. And the one thing that did surprise me about studying all of this, the system does reward responsible behavior more than it rewards debt. You can reach that exceptional credit score tier with zero credit card debt, zero car payments, and no mortgage. But I do want to put the nail in the coffin on that final objection that I hear all the time. It's the biggest gripe that I have about such a common credit score misconception. And that is this idea that carrying a balance on my credit card boosts my credit score. It's a lie that credit card companies and banks want you to believe. And of course, think about the conflict of interest here. They want you to carry debt so that you have to pay interest to them. They want you to do that, and it does not boost your credit score at all. You do not have to carry debt in order to get a good credit score. I have never paid a penny of interest on a single credit card that we have, and we both have fantastic credit scores. So please walk away from this knowing you don't have to carry a balance on your credit score. If that's the one thing you take away, then great. But we learned a lot in today's episode, and we're going to wrap it all up next. I have a great action item for each and every one of you. So today's action item to get started with all this is to go to annualcreditreport.com and pull your credit report and make sure it's accurate. And then from there, you can begin to work on all that we talked about in today's episode to build your credit score so that you can do what you want to do with a great credit score. And if you've ever had a conversation with a family member or a friend about any of these credit score myths that you heard in today's episode, please share this episode with them. Credit scores and credit reports are a whole lot easier to understand than most people realize. And that's because these credit card companies want us to be in debt, so they make it a foggy and murky area so that we aren't sure how to help ourselves. But it's very possible and very doable for you to be able to get a great credit score on your own. So I hope this episode helped you be able to help yourself with your credit score. If you have any questions about setting yourself up to have a better credit score, I'd love to get in touch with each and every one of you. So my offer from this episode is for us to sit down for a free 30-minute phone call, talk about your credit situation, see how you want to use your credit, and what you can do to improve your credit score. So to take action on this, head over to the show notes or the description of this episode, scroll to the bottom and click on my email. Send me an email letting me know you're interested in talking about your credit situation, and we'll go from there. So where does the podcast go from here? Well, next week's episode is one that I am pumped for. Next week, we're talking about one of my favorite questions about money. So be sure to subscribe because I know you're going to leave next week's episode feeling just motivated, pumped up, and excited about your money. So thank you for listening to this week's episode of Financial Planning for Young Adults. I'm your host, Skylar Fleming. Have a great week. And hey, quick heads up. This podcast, it's meant to be educational and it's for entertainment purposes. It's not personalized financial advice for your specific situation. So before you go out and make any big money moves, make sure you chat with a qualified financial professional who knows your full financial picture.